Okay, so let's say you want to lose the maximum amount of money in an investment. Let's talk about that. Okay, so really, investing in general can be a roller coaster. Housing, a little bit less volatile than, say, just stocks, but the market, goes up and down, goes up and down. The general principle of investing: buy low, sell high. So the way to lose the most money is if you buy in high and then the market dips or crashes and you sell at the bottom. Now, for starters, I don't think we're having a housing crash right now. I think really the housing has been going up at a steep incline, starting to plateau out. That's relatively normal business cycles. But keep in mind that the folks that lost the worst in the 2008, 2009 housing crisis. A lot of people were foreclosed on, had no choice but to get out of their investments at the crash. And honestly, there's nothing that can be done about a lot of that. But other folks had a choice. They were concerned about what to do with their investments. And if you had a choice and sold at the bottom, it would have been really painful to see 2009, 12 months, 18 months later, as values, nearly regained everything they had lost. Now, that's not true across the board about every type of stock, every type of investment, or housing prices. A lot of places in the United States did see a pretty dramatic recovery in just 18 months. And then a couple years after that, housing prices really started to get in the black again. And again, various places in the United States would have experienced that differently. Some places took longer to recover, others recovered relatively quickly. But the way to lose the maximum amount of money is to jump off the roller coaster at the bottom. Seeing your investment go down is scary, and you want to have some measure of control. It's really hard just to wait. But when the market goes down, that's when you want to hold on if you can and let it recover. Generally speaking, bull markets, and I know we're applying these principles to housing, but bull markets tend to last for many years at a time, sometimes decades, whereas recessions or bear markets tend to be relatively short. They don't last that long. Maybe precipitated by some event that caused it. In this case, the market slowdown is due to inflation and interest rates and obviously a bunch of other factors. In 2008 and 2009, very different situation. As we've talked about in other videos, it was brought on by multiple factors, but one of the largest was predatory lending and people getting loans for houses they couldn't afford, and then Wall Street, buying those loans in mass, and eventually them starting to mature, starting to fail. And people had heavily invested in that. So, what we're experiencing in the market right now is really nothing like that. Just a general principle to keep in mind is for whatever the market does dip in the future, because again, right now we might be seeing more of a plateau, but eventually it will dip. When it does, if you have control, don't jump on the dip, hold your ground, be patient, let the investment go up. Keep that in mind.